So are you thinking about investing in Disney? Or maybe you're one of my copy traders and already have a position and want to know why I have it as one of my handful of companies that I'm already invested in. Well, in this video I'm going to break down some of the reasons why I think Disney will be worth around double what it's worth now in 6 to 12 months. Stay tuned to find out. Hello and welcome, I'm Wayne from WES Investments, bringing you stock market news, portfolio updates and training on how to make money in the market, all on this channel. So if you're new here, consider subscribing and hitting the bell so that you're notified of my new videos. Boring bits first, I'm not a financial professional, this is not financial advice. Any videos that you find on YouTube are not financial advice. Now, Disney is a huge company and I've broken down this analysis into 4 segments that Disney has created. If you'd like to see video 1, which is about parks, experiences and consumer products, the link is here. Video 2 about the media networks, the link is also going to be up there. Video 3 is about studio entertainment segment and also it's up there. This is video 4, which is about the direct-to-consumer segment. This segment covers international media sales segment of the business, as well as the digital content such as Disney+, ESPN+, Star and Hulu. Now in 2016, the former Disney CEO Bob Iger declared that direct-to-consumer, which is DTC, was their #1 priority as a company. Disney Plus was launched in the USA in November 2019. In that time, Disney Plus has surpassed 60 million subscribers globally. Disney Plus will begin rolling out in the Nordics, Belgium, Luxembourg and Portugal in September, and Latin America is due to follow towards the end of the year. And that's not really bad for a company that had estimated 60 to 90 million subscribers by the end of 2024. That being said, the platform could still do with a lot of work. The search functionality on it is fairly poor. Often you can search for a film and it won't be there and you have to search for it manually. It also feels like it has very limited content outside of the US due to the fact that we only have Disney Plus and not the Hulu services. While originally there were plans to expand the Hulu service globally as well, it looks like they're walking a little bit back on this. It is a shame, as I believe it would be a real linchpin in what could help them jump the global subscribers. As a comparison, Netflix has 61 million subscribers in the US alone and another 106 million for the rest of the world. So Disney has a lot of catching up to do. I believe that it is unlikely that Disney Plus on its own will catch up Netflix. Netflix has such a broad range of content that everyone can find something they want to watch. Disney Plus is trying to do this with its Marvel and Star Wars offerings, but it just isn't enough. It also has a huge library of classic family feels, which again are great, but they appeal to the same family audience. On this note, in its last earnings call, linked to my video here, Disney stated that they are launching Star as its international adult aimed content. Not that kind of adult content. Get your mind out the gutter. This, for me, is exactly what I've been waiting for to make Disney online content to be able to match and beat Netflix. I personally only have online TV channels. I've got no cable TV, no TV license, and I have Amazon, Disney Plus and Netflix. I would say that Disney Plus is the one that gets the most watch time in my house. However, if I was forced to drop one, it would actually be quite a hard choice. And it could be Disney due to the fact of that whole lack of grown-up stuff. Amazon subscription being linked to the delivery service kind of feels like you're just getting the free TV content. Many people just don't see it as paying for that TV service when they consider if they should cancel it, which leaves Netflix versus Disney. And the more I think about it, the more I see myself picking up or dropping Netflix on demand, while Disney, due to the child content, could quite easily seem to remain as a staple. I believe the ease of access to Disney Plus will make Disney Plus far more of a family staple than the Disney Channel ever was. With the current generation of children mostly moving towards more smart devices at home, A child TV app is going to be a higher demand than a child's TV package. Disney Plus is the only children's specific TV service available at this time. When you think of children's films, you think of Disney, while Netflix and Amazon does have some content on them for the children. It is very slim pickings in comparison to Disney Plus. Due to this, I could see most middle-class families with younger children owning a Disney Plus subscription, which could quite easily continue as they grow a little older too. However, that would be a risk for Disney and the need for Hulu to go international. Otherwise, these customers would be lost when the child in the family outgrows the Disney content. Remember as well that for Disney, it isn't just about the subscriber numbers. It's better for Disney as a company to have 10 high-earning subscribers compared to 20 low-earning subscribers, because the high earners are far more likely to pay for other Disney elements, like going to Disneyland or buying more Disney toys, or other Disney licensed content. Disney has announced that it plans to invest a further $1 billion over 2020 on content for Disney+. This will climb to $2.5 billion for 2024. On top of this, amortization expenses are expected to be around $2 billion. This brings the total expenses for 2024 content to $4.5 billion. And that is just that year. That's all they're planning on spending that year in 2024. I've not been able to find any expected cost for the upkeep of Disney Plus. With 90 million users, Disney's target for 2024, this is the point when Disney has stated that they expect to become profitable. This means if Disney reaches 90 million subscribers before 2024, it is likely to be making a healthy profit in the time before that, due to the lower expected content expenses. We already know that they have over 60 million subscribers. That means they're well over 2/3 of the way there in 1/4 of the time expected. While I do not expect the current growth rate to continue at the same speed, I do believe that growth will continue at a very fast pace, and I can see Disney reaching the 90 million figure early 2021. So I just want to talk about Hulu quickly. In the first quarter, Hulu saw the successful launch of FX on Hulu. Nearly 45% of Hulu subscribers have accessed this library currently and original content from FX Network on the service. Also, Hulu's strong original series continues to perform extremely well, as evidenced by the critically acclaimed hit series Little Fires Everywhere, among many others. And if you're in the UK, Little Fires Everywhere is actually on Amazon Prime, so they've sold the rights to Amazon for the UK. I don't know where else. There's a chance to watch that series if you want to. It's really good. Hulu had 32 million total subscribers at the end of Q2. Remember that this is the US only, and it's about half the number of subscribers that Netflix has for the US. So if they managed to expand internationally and matched the same percentage, that would be an additional 50 million international subscribers. How likely is this to happen? Well, technically Comcast still owns 33% of Hulu. Disney has agreed to buy that 33% stake on a valuation, but I believe that valuation will be in 5 years' time, which is when that sale actually goes through. So Disney and Comcast are kind of stuck together with this Hulu deal for the next I think it's still another 4 years to go. And based on that, I think that Disney is keeping Hulu as a US based only to minimise the cost of that extra part of the business. That being said, I also understand that there may be licensing issues here, but I think the longer it takes for Hulu to enter the global market, it's just lost revenue that's going to Netflix instead. The only flip side of this is that I do wonder if Disney is releasing Star as their international version of Hulu instead, with the intention that maybe Hulu and Star may merge once Disney takes full ownership in 2024. Another main goal for the direct-to-consumer Disney team is to increase average revenue per user, ARPU. An increase here will mostly just increase the bottom line. Increasing the use of Hulu or Star, as I've just described, would be a very easy win for increasing the ARPU. However, the other packages that Netflix use includes upgrades to HD or increasing the number of devices. At the moment, Netflix charges in the UK $5.99 for one screen and downloads on one device, $8.99 for two devices and HD, or $11.99 for four devices and Ultra HD. At the moment, one package that Disney provides covers all bases. In the future, this could be expanded out to mirror the multiple Netflix packages, and could be an easy win for increasing the average revenue per user. However, it does risk losing subscribers by increasing the price of the package that they would need. But remember that I've said before about Disney benefiting more from higher earning families. This is not really the same benefit for a company like Netflix. The most that they would get from a UK customer, for example, is $11.99 a month. They have no way of further capitalising on that customer. The direct-to-consumer element has incurred a significant start-up cost. Hulu is still running at quite a high loss. In 2018, Disney owned just 30% of Hulu, and it incurred them a $500 million loss. In 2019, with the addition of another 37%, it contributed to the overall direct-to-consumer department losing $1.8 billion. This is compared to an overall loss of just over $740 million in 2018. Now, on paper, this big increase is very concerning. However, when you consider this investment in the future of the direct-to-consumer department and the rapid growth in subscribers will mean this loss should turn into significant profits over the next couple of years. Now, moving over to ESPN Plus, and many of my comments here may actually apply to both ESPN Plus and standard ESPN, but I do believe that there will over time be a complete shift from ESPN over to ESPN Plus, so just take that into consideration with everything that I'm saying here. Now, ESPN took what has historically been an engaging live event and turned it into a virtual one with the NFL Draft. This resulted in a bigger audience than ever before, with a record 55 million plus viewers over the 3-day event. The draft was a particularly impressive technological feat, driven by more than 600 remote camera feeds from homes across the US. When you look at the impact of these two events, ESPN's April primetime audience was up 11% versus last year among adults 18 to 49. In fact, it ranked as the top cable network amongst this key demographic. This may sound impressive, but remember, at the time of this, many people were already confined to their homes, and there was also very little sporting activity going on. ESPN and ESPN Plus also aired a virtual 2020 ESPY on June the 21st. This is, for those of you that don't know, Excellence in Sports Performance yearly, and they normally hand out awards in this. This gathered an audience of 500,000 compared with nearly 4 million last year. So obviously there are a number of reasons that this was lower, but this is still quite a big blow for ESPN. Sports will come back, and when they do, I believe ESPN is best positioned to benefit with more offerings than anyone else. It will be a gradual process where sports return for a period without spectators in the stands. ESPN will bring the same level of innovation that we saw with the NFL draft and continue to deliver a great experience for sports fans. Despite all of this, ESPN is struggling with raising costs of production and dropping revenue. I believe that this is largely due to the fall in popularity of sports overall, where sports players are still very highly paid, which means costs are higher than they should be. I believe over time we will see sports stars' wages will have peaked and will slowly start to come down, bringing the cost of the rights for the games down. However, this will not happen quickly. It will cause losses for sports teams as well as content makers, but will likely not impact the share price for some time. Now, let's consider worldwide sports. With ESPN, Disney already has considerable US sports rights. With Hotstar, they also have rights to sports in India. I believe Disney may think that the only way to make it worth paying for the global rights to sports is to ensure that they also purchase the rights to sports globally as well. For example, you could argue that a UK sports fan is unlikely to subscribe to ESPN unless the sports also include UK sports. However, with a monthly subscription fee, This could mean that subscribers could just subscribe for the specific events that they want to watch. And with a back catalogue of sports content like they are making for the moment, it would absolutely see it being worth the same cost. For example, a UK customer that is interested in American football is probably not as interested in normal football or soccer, and they may be more likely to pay the $5 a month for ESPN rather than the existing subscription. This could help ESPN expand internationally, which will make the purchases of more international content viable, increasing the customer base further. The future for ESPN is going to be expensive. To expand this offering, they will be required to significantly invest. Internationally, the service is quite expensive at $9.99 a month. I don't know the full extent of the sports content, as this is not a service I normally sign up for. As the sports are cancelled at the moment, there is also only old content on ESPN at the moment. Also, from my understanding, much of the major sports are still locked up with very expensive contracts, while the other TV networks at this time. When these are available for renewal, it will be interesting to see if ESPN bids for these events, or if they continue to focus on less mainstream events. This appears to be the main focus for ESPN due to the rights deal with the UFC. The focus on these less mainstream events means that the streaming costs are much lower. However, due to the lower cost of the subscription compared to standard TV subscriptions, this could mean ESPN could make a far more viable option for fans of these niche sports, gaining ESPN more of a cult following. The on-demand nature of these events could also be far more valuable to viewers who can watch the events when they would. The on-demand nature of these events would also be far more valuable to viewers who can watch the events when they are ready, rather than getting up at 2 AM in the morning because they're on the other side of the world. While I believe streaming is the future compared to over-the-air TV, I think sports is going to be a market lagger. There are 3 reasons for this. The benefit of streaming on demand are lost on sports games where people often just want to watch them live, and if not, people can often just record the game and catch it at their own convenience. You wouldn't just binge watch the latest season of baseball. I believe the market group of people that watch sports are least likely to be tech savvy as a whole, and therefore are more likely to remain watching over-the-air TV rather than moving to streaming. And I mean this is a very broad generalisation. For example, I believe that millennials, who are the oldest group to really be moving into streaming, are less likely to watch sports, with younger viewers even less likely. The younger viewers of sport are more likely to use ESPN, but I believe they are a small section of the market. The negatives of streaming are that you have your internet dealing with your viewing. If you're watching a sports game and you could be watching it completely fine with no buffering and no glitches, or you could watch it online where you do have those risks, which would you choose? Well, if there's no benefit to watching online, then why would you switch to a service that could be worse? On the flip side, Disney Plus is expected to be profitable by 2024. However, ESPN Plus is expected to be profitable a year earlier at 2023. Now moving on to Hotstar. This segment has been rebranded Disney Plus Hotstar, which has 18 million paying subscribers. Although this platform is very different from normal Disney Plus, as it has a whole selection of content from a host of other US producers, such as AMC's Walking Dead, as well as content aimed at the Bollywood audience. The Indian-made content is currently leveraged through paid TV subscription services internationally. However, with the increasing global community, I feel that adding Hotstar to the international packages could be another way to increase the ARPU. It would be interesting to see if Disney does include the Bollywood content as part of the Star package when it pushes it out to the rest of the world. Imagine the huge international population that already has Disney Plus, but also has Indian heritage, or even just likes the Bollywood genre. You could quite easily add at least another $5 a month for this service. From what I can tell, the only way to watch Hotstar and other Indian-made content in the UK is through a TV subscription, which starts at £25 a month, or about $31 for Sky TV. Or you can use the Asian package through a Virgin TV subscription, which costs an extra £12 or $15. I assume that this is similar around the world and would make this far easier for customers to subscribe to, and I believe provide a better return for Disney. Any attempt to watch Star Online is blocked by geolocation and a VPN is required, so it's possible if you can get around the system, but it's not easy for non-technical people, which is the majority of the public. This makes me believe that it's not only a high level of demand, but also potential to reach a market that could be very keen to replace their existing general subscription with more market-focused subscriptions. Would you, for example, rather pay $31 for a huge selection of channels with loads of channels that you don't use, or $5 for most of the content that you do want to watch? And it also makes it far more affordable, so that could quite easily boost up a huge number of subscribers there. Other than a side note of the launch of Star, Disney had made no announcement and has no plans, from what I can tell, to do it to this extent. Like I've said, maybe the content will be just added to Hulu, or maybe they're just not going to bother at all. This is an easy opportunity for them that I believe would be far more profitable than from them selling the channels to a TV subscription service. But for me, this is the beauty of this segment and the opportunity for investment. For me, Disney has a huge amount of potential here and could make considerably more money going forward. This is one of the many reasons why I think Disney is worth buying, but I'll go over that in my next video. Now, as I've already said, Disney owns a lot of stuff, and this is one segment. Thank you for watching, and I hope you found this video helpful. If you have, please give me the thumbs up, and please make sure to catch the next video, which will be the conclusion of this series, and it will sum it all up. And I'll see you there.